Let's bring some common sense and rationale to this discussion of the coronavirus and the stock market. And we will talk about that in just a moment. Stick around. Thanks for watching this video. This is an important and timely topic, and it's something that you should really think about with more perspective than the news may be letting on or the panicked markets may be letting on. So let's talk about what's going on. Basically, throughout history, since the beginning of the stock market, we have had what are commonly referred to as geopolitical events that can impact the market. Some of them have had a large impact on the market in the past, and some of them have not. A recent example is when the tensions were wound up between the US and Iran. After Iran fired at some of our soldiers and we killed one of their generals, that would normally have really rattled the markets in the past. But when it happened more recently, the markets just kind of shrugged it off. There was very little impact. There are other things in the past, such as wars or oil prices, or of course 9/11, that have had a dramatic impact on the market. But what has happened in every single case? Did it put the markets in a tailspin that it never recovered from? Did the markets go into a prolonged bear market and never recover? No. No, the markets are resilient. The markets have the ability to rebound. And they have time and time again. So when one of these geopolitical events has been strong enough and concerning enough to impact investors, it has caused the market to tank or take a dive. And then eventually the market has rebounded, as it has throughout its history, even after the Great Depression, even after the events of Black Monday in 1987, the markets have always turned around and rallied and come back. A lot of people are already forgetting that we went through the N1H1 flu pandemic, also known as the swine flu, as recently as 2009, 2010. And many accurate estimates, and especially in a reevaluation of estimates in more recent years, have found that there were probably over 200,000 people that lost their lives during that pandemic. Now, did that cause the stock market to go into a prolonged bear market that it never recovered from? No. Did the housing crisis around the same time cause the stock market to go into a prolonged tailspin that it never recovered from? No, of course not. And what about the credit or financial crisis? The dot-com crisis at the end of the 90s and beginning of 2000. Did any of these things cause the market to go into a prolonged tailspin that it has never recovered from? And the answer in every case is no. What has happened, and to some degree it could be argued what is happening now, is with the dot-com crisis or the tech crisis, depending on who you ask, company stocks were overvalued, substantially so. Valuations on many tech companies were just irrationally high, which is where the well-known quote from the former Federal Reserve Chairman comes in about irrational exuberance. People get caught up in the market. They don't consider how strong the fundamentals of a company are. They just want to buy stocks. And the market gets propelled ahead. It goes up and up and up. And then some more rational thinking comes into play, and people look at these valuations and say, wow, the market is overbought. These companies don't have fundamentals that support these stock prices. And as usually happens, the market prices a stock accurately. To some degree, this is what is happening with the coronavirus. The market has become overvalued. Many stock prices are irrationally high, considering the company's fundamentals or the true value of the stock. And it was almost as if the coronavirus was a tipping point or an excuse for investors to start taking profits from those stocks, and you have seen this precipitous drop in the market. Now, are there other fundamentals and considerations and other impacts because of the coronavirus that would impact the market? Yes, of course. We've seen an enormous disruption in air travel. We've seen video of some passenger jets in Europe that are almost empty. For those of us that are my age and older, we can recall the days when we would get on a passenger jet and you would have open seats on either side so you could stretch out a little bit. You don't see that normally anymore as the airlines pack planes up and make certain that they do not have a flight touch off without it being full or close to full. So this is definitely going to impact the profits of the airlines. We've seen an enormous impact on the cruise ship industry. And no doubt the stocks of cruise ship companies as well as airlines will be impacted. And certainly the travel industry as a whole will be impacted by this as people are more reluctant to travel. Many of the resort hotels in places like Scottsdale, Arizona right now are reducing prices, even though this is in season for them. And they are doing what they can to fill up rooms and to address this problem. Other companies are making use of either telecommuting or teleconferencing so that they don't have to bring people together in the same room. And this is benefiting the stocks of those companies that make disinfectants and other products like face masks and other things. If they are public companies, are also benefiting by this. So not every company is negatively impacted by the coronavirus. But the important thing to learn is that this is nothing new. This has happened many, many times in the past. There have been many disruptions to the markets. There have been many of these geopolitical events that have impacted the stock market, whether or not it's disruption to oil trade, a terrorist attack. Of course, as I mentioned earlier, something as profound as 9/11 that literally impacted Wall Street itself, with traders not knowing if it was safe to be on the floor of the exchange. But in every case, and this is my message to you, in every case, the markets have come back. They've rallied back. And the reason we are at all-time highs in the market, and the reason why before this coronavirus scare has toppled the markets more recently, we've been in a 10.5-year mostly rally, because the business atmosphere is good. We just had some important trade deals ratified, both throughout North America as well as between the U.S. and China. Unemployment in the U.S. has been very low in the last few years, and regulations have been taken off companies, and we've seen deregulations so that companies don't have to try to store up capital somewhere to pay fines or government penalties. They can hire people instead. So when the coronavirus scare is mitigated, when the healthcare officials and the doctors are able to get a hold of this, after, to some extent, whatever seasonality it has, after that passes and new cases begin to de-escalate and are reduced in numbers, the strong fundamentals that exist in the economy will again become more important, and investors will see that it is again a good time to buy stocks, many of which now at this time are either at more reasonable levels, more realistic levels, and some of them are even bargains. So while the coronavirus will come and go and unfortunately take a toll on a number of people, history tells us that it is not the end of the world, that the stock market will once again rally, and that is the real story here. If this is useful information to you, please subscribe to this channel, and please like this video, and come back in the future for more videos that address wealth creation, building up assets, investments, and good decision making. Thanks for watching.